Good evening, everyone. Welcome to the channel. Before I begin, here are my disclaimers. Today I am going to give you an update about COSCO Shipping Energy Transportation Co. Limited Annual Report. COSCO Shipping Energy Transportation Co. Limited offers a diverse range of businesses and services to cater to the global energy transportation needs. The company specializes in transporting oil and liquefied natural gas, LNG, across international borders, including within the People's Republic of China. In addition to its core transportation business, COSCO Shipping Energy Transportation Co. Limited also provides chartering services for vessels, allowing it to offer flexible solutions to clients with varying needs. The company further extends its services by shipping liquefied petroleum gas, LPG, and offering shipping agency services to support the logistics of energy transportation. The company's extensive fleet comprises 159 oil tankers with a combined capacity of 23.74 million deadweight tons, as well as investments in 87 LNG vessels, including 50 vessels with a capacity of 8.42 million cubic meters. This robust infrastructure enables COSCO Shipping Energy Transportation Co. Limited to efficiently transport energy resources across the globe. Overall, COSCO Shipping Energy Transportation Co. Limited's comprehensive range of services and extensive fleet make it a leading player in the global energy transportation industry. COSCO Shipping Energy Transportation Co. Limited market capitalization of $132 billion is significantly larger than the average industry peer of roughly $0 billion. This shows that COSCO Shipping Energy Transportation Co. Limited holds a significant advantage in their industry. COSCO Shipping Energy Transportation Co. Limited trades at a higher price-to-earnings ratio of 20 times and a higher price-to-book ratio of 1.97 times relative within the industry. While the stock does not screen as absolutely cheap, mixed valuation signals relative to industry peers prevent a definitive conclusion. With the broader industry trading at lower valuation levels, this may reflect transitional pricing dynamics rather than clear mispricing, warranting further analysis of earnings quality, growth sustainability, and balance sheet strength. The leverage on the balance sheet appears elevated, with liabilities of 52% of total assets. This raises some concern, and we should examine the industry and nature of the business to determine whether they justify the elevated leverage. Liabilities have grown faster than assets and equity, which is somewhat concerning. However, asset growth remains positive, suggesting management may be temporarily leveraging liabilities to fund expansion. Shareholder equity has grown consistently, but operating income growth is weak or inconsistent. Equity expansion may be driven by financing activities rather than core business profitability. The share count has increased over the past 5 years, while revenue has continued to grow. This suggests the business may rely on shareholder dilution to fund expansion. Investors should closely monitor whether growth can eventually be sustained without dilution. The company have a dividend yield of 2.48%. The income statement shows that the company have been growing its revenue annually, but the operating income have not been increasing. This shows that the business is under pressure with rising cost. The primary drivers of revenue growth or decline can be identified through an analysis of the key factors that have impacted a company's financial performance. On the positive side, revenue growth has been driven by several factors, including a significant increase in other income and gains, net, which rose by 78.5% year-over-year. Additionally, oil shipment volumes increased by 8.6%, while LPG transportation saw a notable rise of 19.7%. Domestic revenues also experienced a substantial boost of 22.3%, with transportation volume increasing by 2.6%. Furthermore, the company's principal operations witnessed a revenue growth of 2.3%, and international crude oil revenue grew by 17%. LNG shipping and LPG shipping also saw significant increases in revenue, at 14.3% and 20%, respectively. On the other hand, revenue decline was primarily driven by vessel chartering, which decreased by 37.1%, followed closely by LNG shipping, which dropped by 14.3%. LPG transportation and chemical transportation also experienced declines of 12.1% and 20.3%, respectively. Domestic shipping saw a decrease in revenue of 5.4%, while the international oil shipment business reported a mixed performance, with revenue from shipping increasing by 4% year-over-year, but gross profit from shipping decreasing by 6%. Net income and profit margins. A year of change, the company's net income has been subject to fluctuations over the past year. While it remained largely flat at RMB 4.037 billion, there were instances where it decreased by 8.5% year-over-year and increased by 10.4% year-over-year. This inconsistency can be attributed to various factors. Profit margins have also undergone changes, with a notable decrease of 1.2 percentage points due to rising external uncertainty and increased costs of principal operations. Additionally, the profit margin decreased by 0.3 percentage points to 24.8%. However, there was an exception in the LPG shipping business, where profit margins increased by 1.1 percentage points year-over-year. The reasons behind these changes are multifaceted. The gross profit margin decrease can be attributed to rising external uncertainty and a complex global energy trade environment, as well as increased costs of principal operations. Market volatility and changes in trade logistics needs may also have contributed to the decline in net income and profit margins. The company's financial performance has shown a significant improvement in its ability to generate cash from its core operations. According to the latest figures, the company has successfully produced a substantial amount of positive operating cash flow, totaling approximately RMB 7,389,147,000 during the reporting period. This achievement is a testament to the company's efficient management and effective operational strategies, which have enabled it to convert profits into actual cash inflows. As a result, the company is now in a stronger position to invest in its growth initiatives, pay off debts, and reward shareholders with dividends. The debt level of the company has undergone significant changes in recent years. While total liabilities have increased by a mere 0.5%, total debts have seen a more substantial decrease of RMB 982,072.5%. However, the overall picture is one of an increase in total debt level, from RMB 25.02 billion to RMB 28.14 billion. In terms of interest expenses, there has been a notable increase of RMB 82,103, bringing the total finance costs to RMB 558,219. This rise in interest expenses suggests that the company is paying more for its debt obligations. Despite this, it's essential to consider the decrease in net debt and the overall context of the company's financial situation. The performance of various segments and regions in the industry has been mixed, with some showing significant improvement while others have struggled. In terms of strong performers, LPG transportation stands out as a notable success story. The segment saw a substantial increase in revenue growth, rising by 19.7% from 2024 to 2025. This growth was even more pronounced when considering contribution growth, which surged by 24.8% over the same period. On the other hand, LNG shipping has been a poor performer. Revenue and contribution growth have both declined significantly, with revenue falling by 13.6% and contribution decreasing by 16.2% from 2024 to 2025. This decline is a cause for concern in an industry where steady growth is often expected. Management is outlining a forward-thinking strategy for the company's growth and development. The key initiatives include driving innovation through scientific advancements and industrial integration to unlock new productive forces. This approach aims to stimulate internal vitality by implementing institutional reforms, which will likely lead to increased efficiency and competitiveness. The company has also made significant strides in securing contracts, with shipbuilding agreements worth RMB 7.882 billion. This substantial investment demonstrates the company's commitment to expanding its operations and capitalizing on new opportunities. By combining innovative strategies with strategic partnerships, management is positioning the company for long-term success and growth. Based on the extracted summaries, it appears that the company has indeed paid dividends to its shareholders. This is evident from two specific instances mentioned in the summaries. Firstly, page 15 explicitly states that the company paid a final dividend of RMB 0.21 per share in 2024. Secondly, page 51 confirms that the company has a history of paying dividends, further solidifying this conclusion. There is no mention of any share buyback information on these pages, suggesting that the company's focus has been on distributing profits to its shareholders through dividend payments rather than repurchasing shares. That concludes the financial summary for COSCO Shipping Energy Transportation Co. Limited. Feel free to comment below, and I will be happy to answer them when possible.